how much longer can we expect the Fed to keep rates higher for longer? What's going to happen to the stock markets after that? We're talking about these themes with our next guest, Derek Brodie, VP of Strategy at Moomoo Canada. Welcome to the show, Derek.
Thank you so much for having me, David.
I'd like to start by talking about the FOMC minutes, which were released last week. It says here participants affirmed that additional favorable data were required to give them greater confidence that inflation was moving sustainably toward 2%, the meeting summary said. Basically, that means that the Fed is not yet ready to cut rates. Now, why is that? We both live in Canada, for example. The Bank of Canada cut rates, and the inflation rate in Canada is 2.9%. The ECB cut rates. The inflation rate in the Eurozone is far above their 2% target as well overall. So why is it that the Fed needs to wait for data to come lower?
Well, it's a great position and a great comment. I mean, obviously, this is going towards the Fed's goal of max employment and price stability. So I mean that the economy right now is on a very stable footing. The message from the minutes is largely that Powell needs to see that continuing trend towards that 2% goal. So I mean the outlook for their their opinion is that it still remains uncertain, and that the larger issue that I took away from the FOMC minutes was that nominal wage growth was slowing, and I think that that's something to be very mindful of. Their labor market is definitely cooling, and it's at a pace that they're concerned right now. In those minutes, if you took a look at them and parse them out, that it's at an increased risk of pace of layoffs. So I think that that's the biggest thing that needs to be noted as of right now.
Do you think that the Fed's mandate of 2% inflation is a little bit more difficult to reach than their mandate of, I guess, maximum employment right now, currently?
I do. And I think it's going to be something that is not going to be achieved in a short amount of time, like I've talked about with others, in a similar forum as well. I think that the rate of cuts that people have expected here, in terms of interest rate, and from their, projections as market participants, 5.1% at the end of this year, 4.1% at the end of 2025, 3.1% at the end of 26. This is going to be a much slower, rate decrease environment than people are actually understanding. And I think that that's something that investors need to be very mindful of and aware of.
What the Fed is signaling to me, at least, Derek, is that they're not too concerned about the labor market right now because they think that the labor market can withstand rates higher for longer, which is why they're not cutting immediately. Do you agree with that
Correct.
assessment?
I do. I think, though, I would agree with that assessment to a point, David. I think that just right now, the labor market, in terms of the unemployment factor and the divergence, actually, largely between Canada and the States, is right now material. And so I think that that's something that in the Fed's view is something that they are definitely watching closer to make sure that there is not major moves on that front.
Well, you follow both economies closely. In your opinion, which economy has better growth prospects right now, Canada or the U.S.?
I think statistically, it's you can't deny that U.S. has a much better one than Canada. I mean, 1.7% GDP here in Canada versus a projection of 2.8. U.S. was just revised upwards, to 1.4%. Unemployment numbers here within Canada, also ticked up, to 6.4%, versus 4.1% down south of the border. So I think those levels are definitely supporting where the Fed is sticking at as of today, and also largely explaining what the divergence is between our policies, north of the border versus south of the border. So I mean that is the part that is on everyone's mind in terms of keeping rates unchanged south of the border, but obviously having a small price cut here within or interest rate cut here within Canada.
I want to come back to Canada in just a minute, but going back to the U.S. markets, the S&P 500 just continues to grind higher, Derek. Today we're speaking on the 5th of July. It's at 5560 almost. And the question remains whether or not the S&P is factoring in any rate cuts at all this year. Remember at the beginning of the year, in January, I think the markets were factoring in something like 5 or 6 cuts. How many is priced in now, you think?
Well, I think largely you would move that to a figure of 1, possibly 2. And I think a lot of that has to do, more labor market related, to be perfectly honest. I think that the Fed has appreciated the level of resiliency in the U.S. consumer, and I think that is something that they didn't quite necessarily predict, properly. I think we're going to still be largely in a muddle through environment. If you had asked anybody, based off of the factors that we're looking at right now in terms of, Federal Reserve policy, do we think that this is where markets would be at if you asked people a year ago? And my answer would be no. There's way too many, factors that have come into play that have obviously, stemmed the policy, elements that they've done.
Generally speaking, Derek, do you believe that the U.S. equity markets are disconnected, shall we say, from the real economy?
Absolutely. I do think that there is a strong, divergence between, where the economy is and the stock market. So I think that there is a large concentration risk developing, and I'll explain that in terms of a stat that I reviewed today from JP Morgan's research was actually describing how NVIDIA shares have contributed to a third of the S&P 500's return, year to date. This is really largely giving investors the illusion that markets are really doing a lot better than the actual fact the underlying companies might actually be doing.
Let's talk about tech and NVIDIA now. The tech sector is the only sector beating the rest of the S&P 500 this year to date. NVIDIA contributed to a lot of the PE growth this year. The question remains, is tech overstretched? Is it now time for a pullback? Is this the top? What do you think?
My answer to something as specific as that, David, is always the momentum has been a big factor in this, and I think the AI push that is seen there, and all the supporting factors and companies within that space have absolutely benefited. Do I think that this is a long-term trend that is going to continue on the path that is done so far? The answer is no. I don't believe that is something that is a sustainable trend on what it's done so far. Having said that, is it a segment that people should be mindful of and absolutely have a piece of their portfolio associated with it? Yes, and the reason for that is, it's a fear of missing out is largely what I believe it comes down to. That if people take their portfolios and say, I don't absolutely believe any of this, and it's not, you absolutely run the risk of not having any benefit of participating in that in that momentum trade.
When you consider that tech is the only sector that has continuously run up this year, and all the other 8 sectors, except for one other, have actually declined since the beginning of June or mid-May and have just traded range bound, this divergence in the stock markets versus tech, how do you respond to that? What's your reaction?
I think that it's much like I just said earlier, that a lot of this has to do with the momentum play and where people are trying to reach to find the growth. So I think that this is an emerging story within markets, and I think it's one to be paying attention to. However, my natural inclination is to move things to a little bit more risk off, approach for clients and how they're actually, viewing their portfolios. And what I mean by that is in terms of the broader mix of what they're going to be concentrated on. And I find that is actually the largest piece where people lose their way, in some respects, because they suddenly go, well, I think this is where I should do, where everybody else is going. And I think that's a dangerous path to be on in life, and especially within capital markets. I think that you have to have a bit of a balance and understand what you're comfortable with, and realize what that trend is, and make sure that you're not just following the herd, for lack of a better term.
One of the bigger stories, at least amongst the grocery stores in the last month, is that a lot of them are cutting prices. So this is from the Washington Post. There's many articles about this, but retailers are finally cutting prices. Will last. Ford recently marked down his electric Mustang Mach-E. You and I were just talking about cars offline. We're talking about different types of cars. But anyway, some cars are cutting prices. Grocery stores, like I mentioned, Target, Amazon's online grocery division has been cutting prices in the last 2 months or so. I wonder if margins are going to face a deterioration over the next coming quarters. Is that something that you're looking at, Derek?
Yeah, absolutely. I think it's a valid point of concern, and it will continue to be. If you, myself, I love to read between the data and to listen to anecdotal elements that get shared from Jay Powell. After the last FOMC meeting, there was a reporter who asked him about the element of cost, consumers actually bearing the cost of price increases that have been shared their way, right? And the comment from the reporter was asking about his thoughts on McDonald's meal deals and their prices coming down. I always find that personally kind of funny, thinking of Jay Powell having a Big Mac meal. It just doesn't seem to be something that perfectly aligns for myself. I think that through just as a broader sentiment to that, a lot of us felt that the price increases through COVID we accepted, and there's now actually a larger tipping point that's coming into place where people are realizing what they're spending their funds on and are more thoughtful about what those are being allocated towards. So I think that the business outlook survey that I just reviewed the other day, was pointing to fewer firms are actually not going to be making unusually large or frequent price increase over the coming 12 months. And I think that that's something that has to be, mindful in terms of, or our overview of the market.
Does this indicate to you either strength or weakness in the consumer, Derek, right now?
I think that the consumer is strong. I think that there comes a point where it starts to deviate from that, David. So I think that to say that the resiliency of the consumer has, in my opinion, and I believe that the Fed has echoed this as well, largely outpaced what they felt they could handle. And I'm not so sure that is going to be also, again, a trend that can continue in perpetuity. So, much like the adage that seems very silly, the trend is your friend. I feel that right now the consumer is still at a point where they are strong, but that comes a point where that can't continue, under the present scenarios.
I like to talk about commodities now. Commodities are a big chunk of the Canadian economy where you and I both reside.
Yep.
Oil, base metals, precious metals to some extent. Where do you see this sector headed?
Long term, I am bullish on commodities. I think that we've seen a large element of volatility in this space. I don't believe that trend is actually going to change. I think that having a balanced approach to commodities is the way to go. I think, especially within here in Canada, as so go the commodities, so goes the TSX, in comparison to the S&P 500. So I think that in terms of maybe investor allocation to commodities in the space, if it's whatever they're going to choose, if it's metals, if it's oil, if it's whatever it happens to be, is not for the faint of heart, David. And I think that that's the part that has to be mindful for all investors, quite frankly. I think the concentration risk to just suddenly saying commodities is where I'm going to put all my eggs in one basket, personally, I think is a very dangerous spot to be. And I don't think that that's something that's particularly thoughtful as part of an overall portfolio weighting risk.
Okay. Do you think that perhaps a slowdown in the economy, I'm not saying it will come, but suppose it comes, would that have any adverse impact on the base metals, copper, for example, tin, palladium?
Absolutely. Yeah, there's no question that will create a slowdown within our economy for sure. I agree with that sentiment completely.
The economy of Canada is peculiar. The inflation rate has been sticky around 2.9 to 3.1% ever since last year, 2023. While the U.S. inflation rate has been cooling somewhat, Canada's inflation rate just remains sticky. Can we think of a reason as to why?
In terms of the divergence between inflation rates here,
or in terms of why Canada's inflation rate just refuses to come down below 2.7 and just stay there?
I think it speaks to the broader economic strokes that are still impacting our economy, from a GDP, perspective here within Canada. And I think that, the U.S. consumer and what they've been able to produce, over the last, say, 3/4 of, Canada being at 1.7, 0.1 negative, in Q3, the U.S. has largely been able, and we have, quite frankly, able to avoid a recession. And I think that that's really the reason for that divergence between economies, David.
When the Bank of Canada cut rates earlier in June, were you surprised?
No, I wasn't. I feel that their telegraphing the market right now that these are changes that they're seeing positive indicators within their data, which they are. I would be cautious as to no different than the States feeling that the idea that this is going to be suddenly a rate reduction environment, both here and for the United States, that is going to just run its way down. I'm not seeing that. I'm not feeling that. I don't believe that that is something that's going to be prudent policy. We talked about earlier this element of I feel it's largely a pendulum effect, and so things swing one way and they swing back. And right now, as far as I'm concerned, central bankers have had a very difficult environment to work within. And the reason why I say that is that they're kind of a bit, between a rock and a hard place. So the idea of moving too fast right now, they're not in that, and have inflation pick back up going the other way is the reason why they're not doing that. And so right now they're telegraphing the fact that things are improving, but they still want to see that there is more and more continuous data points that are actually benefiting the economy and from that, the consumer.
Just one question about real estate. You live near the Toronto region. Have you noticed, at least in Toronto, any changes in sentiment towards real estate buying, that is, given that the Bank of Canada cut rates by 25 basis points? It's just one cut, but have people changed their outlook?
So great question. I feel that the real estate environment here within the GTA, which is not unlike yourself within Vancouver, clients are really looking for almost more confidence themselves to really before they're actually making that move. Now, there's always two sides to that story. The one being, if you ask realtors, this is the time that they should be actually moving up the market, if that's actually in fact what they're doing, because the prices actually are so low. But there is obviously the connectivity between, your present home and the home that you're moving to. I feel that there is a largely hesitant community within the GTA, and quite frankly here within Ontario. As the GTA goes, the rest of the province largely goes. There's many pockets within Ontario, for that matter, and across the all our provinces that have pockets that have done particularly well of late, and I think that was almost largely due to a lagging factor. But the end of the day, the story is that I think in Canada, our immigration policy is supporting a lot of those real estate supports, quite frankly, and that the amount of immigration that we have within Canada is keeping that floor on our real estate market where it is right now. And it, if you ask me, again, I'm a long-term optimist and bullish on the sector if it's in a quality place. I feel that real estate is going to be sustainable, at the levels that it's at right now, and I don't see in my view this bubble that is really moving to what we've seen within our friends south of the border.
Well, that begs the question as to why one, I guess this is more philosophical, but why one should invest in the stock markets to preserve wealth or beat inflation in the first place, given that there's so many other things we can look at, real estate being one thing we just discussed, CDs, treasuries, they're yielding good returns right now with rates the way they are. Any particular reason we should be looking at stocks in the first place?
Because they're always a great hedge against inflation long term. And I think if you actually look at how successful people manage their entire wealth, is not just their stock portfolio, their real estate portfolio. They do it in a very diversified and balanced manner. They have a second home. They have a business interest. It's not just something that they're concentrating within one space. So I think really to stick on that is that none of these things absolutely move in connection throughout the continuum. And I think that people need to be mindful of which assets they have concentration within. So, I always have pointed that within, say, the real estate market within Canada, is that putting all of your eggs in one basket, would have largely seen you have a significant divergence from what the stock market has done here over the last number of years, especially here within Canada. So I think, you have to have a lot of good advice, like good advice and good information and good research that you're receiving on what you want to do, and making sure that that you're not getting caught off guard when prices go the other way.
I know you follow institutional holdings and their well, big institutions, that is, with the
Mhm.
Moomoo institution service. We'll get to that in just a bit. It's a tool that's very interesting. Berkshire Hathaway reported Q1 results last month, and what was interesting is that they recorded a record stockpile. Sorry, cash pile, not stockpile, cash pile of
Yep.
$189 billion. This is the most cash they've ever held on record. I'm getting both sides of the debate. On the one hand, the bears are pointing to the fact that Berkshire Hathaway is preparing for a market crash. That's why they're piling into cash. On the other hand, they're saying the bulls are saying no, this has nothing to do with the market crash. This is just the way Berkshire Hathaway rotates capital on a quarterly basis. Where do you stand on this?
I would be more in door number two there, David, in that this is nothing new for Berkshire Hathaway, that they deploy cash at opportune times. Now, the part that I do feel is really more the measure of Berkshire Hathaway's core values is that they really don't get scared out of the stock market. And that these are, again, if you're a student of anything in life, you should be listening to the smartest people in the room. And Warren is definitely one of those people. So yeah, this idea that the cash hoard that they've got right now is something to be concerned with. I'm not feeling that way. They are patient. They are, long term. I mean, I've been in this business for far too long, and I remember that there was a point where everybody was largely criticizing Buffett and his values, saying he doesn't invest in things that he doesn't understand, and that was a lot to do with technology, especially at that time, and laughing at him and saying, the old man's missed the plot, and clearly that has not been the case, and it will continue to be something that he does, well, as long as he's in that position. So, I mean, the one point of note to that is the fact that he has been increasing his short-term treasuries significantly, right? He's getting paid to wait while he's then can rotate that out when a better buying opportunity comes along. The part that I always reference that to, especially to newer investors, is the fact that Warren Buffett is extremely disciplined. He does not do things that don't make him comfortable. And so when he understands the risk associated with that, that's when he deploys that cash. I do always, say that as a comparison. I would love to speak with his cardiologist, because his diet is definitely suspicious in terms of just discipline. But the fact is that he absolutely is more disciplined than most, does not get panicked by short-term movements. But again, he's not always right either. I mean, if you look at his Paramount holdings, that is one that he will be the first to acknowledge that did not go well. So I think it's something that people can learn from that. Not every trade that people make is going to go the right way. The difference is that I feel that in his disciplined philosophy, he feels when he's made a mistake, he quickly addresses that and calls it for what it is.
How old is he now? He's in his 80s,
Yeah.
90s, 90s. Yeah, I think he's in his 90s now. Yeah, tell
Yeah.
that to your doctors who tell you that fast food isn't going to make you live long. Stick up for the
Exactly.
doctors. How do you follow? Let's talk about the institutional tracker now. How do you follow Berkshire Hathaway and a bunch of other institutions, the Moomoo institutional tracker? Tell us how that works.
For sure. So in terms of our platform, we have a wonderful experience for our clients that really just empowers them, with smarter tools and education. So right now we have 22 million users, on our platform worldwide. Really, the ability is to actually view, the institutional holdings of what top investment managers, are holding. And so I've always been of the mindset that you have to learn by emulating the best, find out what the best people are doing, and see if that's a trend that aligns with what you want to do. So if that's, Berkshire, ARK, Soros Capital Management, SoftBank, we have all these within our platform that, would not be readily available to actually monitor for the traditional retail client. And it's something that Moomoo feels is is an absolute benefit to our clients, and we provide that so that people can actually see the changes within those portfolios.
Any trends in, I guess, capital rotation or trades that are interesting to note amongst this group of 10 that you track?
Yeah, I think some of the ones that even Buffett speaking on this in terms of late, the adding to Occidental and trimming his Apple shares, and I think that there's a number of those pieces that we could get into larger and debate that whether or not those were the right complete right decisions, for days here. I think that the larger piece, in my opinion, David, is the fact that giving our clients access to see what is being done by largely the smartest people in the room is something that gives that sense of confidence for people that especially are learning how to invest and what they should be doing long term, if that makes sense. So, the one that I always point back to, in this is that, or in this vein, is it staggers me how people can take their knowledge of the grocery store when your mom or dad go into the grocery store and they can acknowledge that something is on sale and they load up on something and take that. I think that's something that they're familiar with, they've dedicated time with, and really that's a lot of what our platform is trying to do, which is educate people to say, hey, these are things that you should be watching for. These are the price monitoring that tools that are available for you to actually start to address and understand those trends within the market so that you're not afraid of them when they happen, or conversely, to take advantage of them when you start to see them. So I think, we've all had experience with people within our relative circles of, quite frankly, horror stories of people having issues with a stock trade that they concentrated way too much of their wealth within. And I believe that really just having proper risk controls in place are vital to long-term success.
These institutions that you track, generally speaking, what makes them successful? What are the things that they do that I guess is worthy to be tracked?
I think a lot of it has to come down to like their risk management and their research, their insight, their ability not to deviate from what their set out policy is, quite frankly, David. So I think that concentration risk is something that even the greatest hedge fund managers on Wall Street, there is, I could point to a number of them that have, and I won't name them because they've made the wrong bets on the wrong things and stayed on them, for too long. And I think that that's something that people don't necessarily appreciate, especially, at a ultra high net worth or an institutional level. No one likes losing money. And so they're capable of understanding when a trade has gone the wrong way and exiting that position. And the smartest ones, in my opinion, figure out at what point they're actually going to exit that trade and say, we're going to stop at this point because it's been enough and we're going to recover here.
Okay. Tell us about some of the other, I guess, services or features of this Moomoo app.
Sure. So I feel that we have one of the most wonderful platforms in terms of our access to the United States stock market. I think that $0 account fees is what we do across the board for all of the types of accounts that we provide. Low commission charges, FX fees from 0.09% plus $2, to convert, in our case, CAD to US. Extended trading hours, versus our, competitors. And really the one that I think that people, I was at an event with institutional providers a few weeks ago, and we were talking about just the level of our platform's technology and that it really is an institutional like feel. And I'm dating myself, but there was a time within the stock market that you had to have access through a broker to have access to these tools. And that was the reason for that. But right now, in terms of, our direct investing and self-directed, you do not need to rely on a broker to provide access to this. We actually provide that for you free of charge. And so I think our platform is extremely intuitive and easy to use. And that's just, again, something from our clients directly.
Well, there's a lot of low-cost brokerages out there now. Derek,
Yeah.
what sets you and Moomoo apart?
So I think there's a number of elements that I just alluded to there earlier. I think that level two quotes in our platform are free. The research capabilities and screeners that we have are extensive. From, like I said earlier, from Morningstar. I think in terms of a differentiating factor, that what we genuinely feel is that we're really trying to bring clients along the continuum in terms of their learning. And so when I say that about the educational element, it's largely that our webinars, tutorials, articles that we provide clients is really to teach them, and then to actually have the broader 22 million within the community to discuss these concepts and to say, hey, how does this actually work? How does this actually benefit me? What have you found that's successful? And so I think that is an extremely powerful differentiator in terms of ourselves versus our competitors. The other one that we haven't touched on is the element of what's called our paper trading feature, and it's an extremely powerful tool. It allows people to experience what trading within the market is, because again, it comes back to in investor psychology, and I think that we appreciate the idea of when you're learning how to do something, trading with real money isn't exactly always a comfortable dynamic for most clients. And so we've created this tool that people can actually trade just as it is within the real market with real actual data. So much like riding a bike without training wheels, we're trying to give you the training wheels as the interim. And so you actually get to do that and experience what it is to be within a portfolio with real dollars that are provided in a synthetic environment. And then you actually gain the confidence to actually then take your own real capital and deploy it within our traditional platform. So I think that does set us apart, because nobody provides the level of sophistication on that paper trading like we do.
Well, just if I want to learn about markets or stocks, find data, how can I do that with the app?
It's extremely easy and intuitive. That if you actually go onto the app, you can actually go through and get all of the data that's pulled there at your fingertips within seconds, David. And it is a I would say that the amount of information is extremely comprehensive. And more than that, I think a lot of it is really teaching our client base to understand what the actual data means. Just providing it doesn't actually allow them the comfort of saying, well, I know what this actually means. You have to understand, what the price to book ratio, what the PE, like all of these elements that really we're trying to make sure that people are empowered to understand what it is that they're looking at and how that fits within their overall portfolio.
Okay, excellent. Well, Derek, I appreciate your time. Thanks for educating us. We'll speak again soon.
Appreciate it. Thank you so much.
And thank you for watching this interview with Derek. Before we go, let me tell you a little bit more about Moomoo. Moomoo is an investment and trading platform that provides investors globally with pro-grade, easy-to-use tools, data, and insights in order to make more informed investment decisions. Moomoo provides free access to investment courses, educational materials, and interactive events that any investor at any level can gain from. Scan my code here on the screen or use the link in the description down below to sign up on Moomoo now. If you are in Canada like me, you can get up to $2,000 in commission rebates after sign up, plus a limited time 6% APY on your uninvested cash and a $200 stock cash coupon with qualified deposits. For U.S. citizens, you could receive up to 15 free stocks when you fund your account, along with an 8.1% limited time APY on idle cash.